Welcome to the explainer. There's this massive multi-trillion dollar industry called private equity, and you'd think it's incredibly complex, right? Well, today, we're going to see how its entire fate, all that money, can hang on just one single number. Let's get right into it.
So here's the big question we're tackling. How is it possible that one little number, the interest rate, can completely change the game for a multi-trillion-dollar industry? I mean, how can it be the difference between a massive boom and a complete bust for some of the biggest names in finance? It sounds crazy, but that's exactly what happens. We're going to break it all down.
Okay, so to really get why interest rates are so powerful here, we've got to pop the hood and see what makes the whole private equity machine run in the first place.
And that engine, it's something called a leveraged buyout. You'll hear people call it an LBO. Now, the name sounds kind of fancy, but the concept is actually pretty straightforward. Imagine you want to buy a company, but you don't want to use much of your own cash. So what do? You borrow almost all of the money. That's it. That's the core idea, using debt to make the purchase.
So just look at this breakdown. In a lot of these deals, the private equity firm itself might only put up, say, 10% of the total price, just a tiny little sliver. And the rest, that massive 90%, that's all debt, borrowed money. Now, using all that leverage is the secret sauce for making huge returns. But, and this is a big but, it's also their Achilles heel. It's their single greatest weakness.
All right, so let's rewind a bit and talk about the good old days, at least for private equity. For a long, long time, we were in a world where interest rates were basically at rock bottom. And for this industry, man, that was the absolute golden age. In a world like that huge pile of debt we were just talking about, it's not a risk, it's a superpower. It becomes a financial accelerator. Think about it. When money is cheap to borrow, it's like you're slamming the gas pedal on your investment. You can go so much farther, so much faster, using just a little bit of your own gas. And this cheap debt just creates this perfect storm for making money. For one, it absolutely turbocharges your returns. That tiny piece of your own money can explode into huge profits. Second, it just opens up the floodgates for more deals. Suddenly, with borrowing so easy, tons of companies that were out of reach are now prime targets. And then, the grand finale. When you're ready to sell the company you bought, the market is on fire. Valuations are through the roof, and you can sell for a massive profit. It really creates this frenzy, As one source we looked at said, investors are willing to pay a higher price for assets. Simple as that. Everybody's desperately looking for a good return, so they're willing to pay top dollar. It's the perfect seller's market if you're a PE firm that's ready to flip a company you've been holding on to. But what happens when the party's over, right? When the music suddenly stops? That's exactly what happened when central banks around the world started jacking up interest rates to fight inflation. And just like that, the entire playbook for private equity got completely flipped upside down. And I mean, it flips fast. You can see it side by side here. That financial accelerator we talked about, bam, it becomes a financial break. All those deals that were possible, suddenly, not so much. And those sky-high prices you could sell for, yeah, they start coming back down to earth. So let's get into exactly why that happens. So if cheap debt was the gas pedal, you can probably guess what expensive debt is. It's like slamming on the brakes, hard. The exact same tool that made them so much money, that leverage, it now turns into a massive anchor, just weighing everything down and grinding it all to a halt. This new reality puts private equity firms in a really tough spot. They're basically fighting a war on 3 different fronts. First, any new deals they want to do are suddenly way more expensive, which eats into any potential profit. Second, the companies they already own are now getting crushed by the interest payments on all that debt they took on. And third, trying to sell those companies? Good luck. The potential buyers are in the same boat. They can't borrow cheap money either, so they're not going to pay those premium prices anymore. And look, this isn't just some abstract problem for Wall Street types. This stuff has a huge ripple effect that actually touches real companies, real jobs, and even big-time investors like the pension funds that manage retirement money for millions of people. You can almost see the dominoes falling, one by one. It all starts with the central banks hiking rates. Then, boom, that debt becomes way more expensive. The next domino? The companies that are loaded up with that debt start to really struggle to make their payments. And then that makes it incredibly difficult for the PE firm to sell the company. So the final domino to fall is that the investors, those pension funds, they're stuck waiting and waiting to get their capital back. So that's the bottom line. That's why all of this really matters. It's not just numbers on a screen. These financial gears grinding to a halt can put real, tangible strain on everyday companies. It gums up the works for the entire M&A market, and yeah, it can directly hit the returns of those huge funds that a lot of us are counting on for retirement. Which leaves us with a huge, fascinating question, right? For more than a decade, the entire private equity model was built on one thing: cheap debt. Now that's gone. The gas pedal has been replaced by a brake. So the whole industry has to figure out a new way to win. The playbook that made them trillions is basically obsolete, and they're being forced to write a new one right now as we speak. The real question is, what's it going to say?